Welcome to Herrick Does That, a podcast on current legal topics, relevant industry and legal trends, and significant developments in the law, brought to you by the attorneys of Herrick Feinstein. I am Belinda Schwartz, Herrick's executive chairperson, and I want to thank you for joining us.
Hello, everybody, and welcome to this episode of Herrick Does That. I'm Yariv Ben-Ari, co-chair of Herrick's hospitality practice, and today we have two wonderful guests. We have Jonathan Falik and Evan Weiss. Evan is the co-founder and chief operating officer of LW Hospitality Advisors, and Jonathan Falik is the founder of JF Capital Advisors, both of whom we've had the pleasure of having on before. Today, we're going to be talking a little bit about takeaways from the ALIS conference that we all recently attended in LA at the end of last month. And before we do that, Evan, why don't you tell us a little bit about LW Hospitality Advisors?
Thanks so much, Yariv, and great to be here with you and Jonathan. Appreciate the invitation. LW Hospitality Advisors, in short, is a real estate services firm focused exclusively and solely on the hospitality and gaming spaces. Three primary verticals of our business: Vertical 1, valuation, appraisals, feasibility studies, market studies, litigation, sport expert testimony. Vertical 2, third-party asset management, consulting advisory, due diligence, underwriting, and assisting folks find brands and management companies into those negotiations. And then a third platform, LARC, Lodging Analytics Research and Consulting, Data Analytics and Market Intelligence for the hospitality space at large.
Fantastic. And Jonathan, tell everybody a little bit about your company, JF Capital Advisors.
Thanks, Yariv. Thanks for having me. Jonathan Falik, founder of JF Capital Advisors. We focus exclusively in the hospitality industry, and we spend the vast majority of our time on complicated transactions. It's a lot of restructurings, recapitalizations, and the complexity that we deal with can be at the operational level, at the capital stack level, or at the ownership level. Sometimes one of the three, sometimes two, and sometimes all three.
Fantastic. So, gentlemen, we both had spent some time together at ALIS. We got to meet a lot of colleagues, a lot of clients, talked to a lot of people, went to the panels, discussions, and I wanted to kind of go around quickly and just share some of the issues and topics that were on people's minds quickly and get your insights and thoughts about them and share them with everybody quickly and briefly. As we kind of are at the beginning of 2025, we're seeing we have a new administration, a lot of executive orders out there, a lot of changes going on, a lot of things happening on the world that are impacting our markets. So let's get right into it and hear your thoughts. I think the biggest topic, tell me if you disagree, that people were talking about was the crackdown on illegal immigration into the country, how this administration is cracking down on it. And in gateway cities or major cities like New York, for example, LA and others, where we've been using hotels to house immigrants for a while now, and that's been an income source for some owners. What's going to happen to some of these assets? What are your thoughts? Maybe, Evan, you want to jump in right there?
I personally think, and I'll give an overall sort of thought process on immigration, and then I'm happy to talk about New York specifically for a minute. Overall, I think that obviously it's coming in hard and fast, beginning of the Trump administration here. It's definitely impactful. There's definitely a lot of fear, I think, amongst the immigrant and the migrant community. Listen, we've had illegal immigration and migration and immigration forever in this country. And it's always sort of been at an equilibrium until the last, 4, 7, 8, 10, 12 years, whatever it may be. And so right now, there's kind of this counterbalance. The pendulum has swung to go after a lot of the illegal migrants. I think a lot of those folks that are being deported or are in danger of being deported, frankly, are criminals or people with criminal pasts. And most of the folks that are here are not of that ilk, and they're really not being targeted for the most part. Again, that's not a carte blanche statement in general. So I think in terms of a labor force and in terms of, the overall accessibility to these folks, yes, I think the next 3 to 6 months probably present challenges as this sort of pendulum swing goes more towards stabilization. But for now, yes, it's going to be challenging. Folks are afraid, folks are nervous, but in the long term, I think it will sort of equalize itself to where we've been from a historical perspective and not where we've been, say, in the last decade. Specific to New York, yes, and other markets like New York, where we've had a lot of hotels that are housing migrants, we've already seen a lot of these hotels, even before the Trump administration took hold on January 20th, we've already seen the wave of migration sort of slow down. We've already seen a lot of these hotels starting to turn back into typical transient hotels. Some of the hotels have gone to close and are being considered as hotels going forward. So I think within the next 24 months, You'll probably see little to no migrant hotels. We've always had a component of homeless hotels in New York City, somewhere around 10, 11,000 rooms per night under the de Blasio administration, under the Bloomberg and Giuliani administration, somewhere between 3,000 and 5,000 rooms a night. So it'll probably stabilize somewhere in that range of, kind of 8 to 12,000 rooms per night, maybe a little bit higher, just given that some migrants will still be in those hotels. But a lot of those hotels will return back to hotels. They'll take 6 to 12 months, 18 months to plan and to execute on renovations post the migrants leaving, and they'll come back into supply. And how it affects the market? Yes, I think it'll affect the lower tier of the market. Generally, a lot of the hotels that went out were on the lower end, sort of, sub $250 average rates. And I think that end of the market will probably see a little bit of a decline in average rate, and occupancies I don't think will really be impacted all that much because there is a significant demand for the city and will continue to be so. And I think it'll remain that way in most urban markets, where in the next 18, 24 months, most of those rooms repatriate to typical hospitality, renovated, and then within another 12 months to 18 months thereafter, you'll see more of a stabilization in those markets where the rooms will be reabsorbed and the markets will act very much in the way they did prior to the influx of immigration over the last 5 to 10 years.
Jonathan, how do you see things?
So I agree with everything that Evan said. I'll add a few additional points. And we've had historically, not even now, we've had issues with non-legal or non-documented labor as we've taken over and repositioned properties. So I'll give a quick example. We took over, and Yariv, this was a deal that you were intimately involved with, the repositioning and restructuring, but we stepped into a portfolio of 3 hotels, 2 of which were in the Dallas area, and 1 of which was in Rhode Island, so in the Northeast. And we brought in, as part of a rebranding process and CapEx infusion process, we brought in a new management company. And the new management company did an E-verification and I-9 verification on all employees. And we had 25 to 35% of the employees in the 2 Dallas properties that either had fake social security numbers or didn't have valid work papers. So we ended up with a lot of turnover in those 2 hotels, and the one in Rhode Island, we had no turnover whatsoever. So, one of the things just to think about as we talk about ALIS and results, a lot of the results, and themes people are talking about are national. Whereas, there are much bigger issues with undocumented or illegal immigrants working in hotels in California, Arizona, Texas, and Florida, right? And that's much more of an issue than in Maine, Boston, Montana, Wyoming, et cetera. So it's not going to hit equally across the board. Additionally, I sit on a council that meets during the ALIS conference, and Evan's partner, Dan Lesser, is there in that council. And we did a survey. And part of the survey was, do you believe, or are you experiencing issues today as a result of the Trump immigration policies? And the vast majority of people, substantially all the people, said, we're not seeing an impact yet, but we very much expect to see some impact over the next year. There will be an impact because there's some fear. And again, there are certain states and certain cities where it's more prevalent. Also much more prevalent where hotels are big users of contract labor. I'll add one general thought on the hotels that were being used for migrant housing, and that is for the larger ones that have been offline for a while. If you put people 100% of the time in a family of 3 or 4 into a 230 square foot guest room, they beat the crap out of that room. They also wreak havoc, not that someone's doing anything wrong, on the utilities and infrastructure of the building. There's just a lot of extra wear and tear.
It just wasn't designed for that purpose.
They weren't designed for that purpose. The plumbing is not designed for that purpose. The elevators, all of the utilities, and then with the structure, there was very limited cleaning. So, and also much less staff. So the typical hotel staff that would have been there, housekeepers, cleaning rooms every day. In most cases, are not cleaning rooms, on a daily basis, doing laundry on the same frequency. So as those hotels need to be kind of put back into transient hotel service, whether branded or not branded, is going to require a lot of CapEx and a lot of repositioning. And a lot of owners took the government contracts because they had no other way of figuring out how to service their debt or refinance their loans. So there will be some who are not that excited about infusing the equity that's required to bring them back into service. It'll be a mixed bag. And in some cases, they'll trade. In some cases, they may go back to a lender. But if you were an owner and you were getting kind of a very steady paycheck, with not a lot of labor, not a lot of headaches, and then all of a sudden you have to take hotel operating risk, that might not be something you're pursuing.
All right, let's take it from there. You mentioned something about having to renovate rooms and so forth. So let's move to a little bit about the capital markets and the availability of debt for these properties. What are you guys seeing in terms of availability of debt? We saw interest rates go down a little bit, but then kind of stopped. What are you guys seeing in that market? Jonathan, to you first.
So, rates down about 100, short-term rates are down about 100 basis points. Long-term rates are not down at all, right? The 10-year Treasury yield is higher than it was, a little higher than it was a year ago, not much, but short-term rates are down about 100 basis points. And in most cases, interest spreads and credit spreads have come in about 100 basis points. So for a kind of plain vanilla financing, you're looking at about 200 basis points less in interest expense than you would have had a year ago. Still substantially higher than it was before rates started to tick up aggressively in the middle of 2022, and still very high relative to the period 2009 to 2022. We find that their debt is readily available. For most borrowers, it's just not at a price, that is attractive or exciting. The commercial banks are in the market, but selectively with their best clients, right? So it's very difficult to go to a large commercial bank, and say, I've never done business with you before, but I'd like to have a loan to acquire or refinance a hotel property. But with long-term clients, they're available. The debt funds are quite active, and the CMBS market is open. But what's unusual for the CMBS market is historically it's been sort of dominated by 10-year financing, and now there's not a lot of 10-year financing for hotels. It's predominantly 5-year financing, and it's really dominated by either single borrower or single asset deals. That's the majority of the volume. But the market is open. People just don't like the cost of debt and some of the terms that go along with it.
I really wanted to go first on that one because Jonathan's answer, fortunately for him and unfortunately for me, is highly comprehensive. I think I would probably just sprinkle in some color. I truly do agree with everything he said about the availability of debt, but with the challenge on the cost and on the terms of the debt, we're experiencing the same thing through the debt brokers as well as from our clients that we're seeing in the market in terms of commercial banks really just doing larger deals with larger clients. If anything, the commercial banks are more active in providing financing to the private lending community. And so the private lenders go out and get either table funded or line of credit or some other credit line mechanism from the larger banks. The larger banks, the credit efficiency for the larger banks is looked upon much better by the regulators if they lend to private lenders, even though the collateral is exactly the same and their level of risk, in fact, is really the same. It seems to be that the regulators look upon that in a much more favorable fashion. So the big commercial banks are essentially putting out relatively the same amount of capital. They're just doing it through conduits of a lot of private lenders. And I think Jonathan's probably seeing this as well, and many folks are. There's a massive amount of new lenders in the market. Frankly, there's one new large significant lender in the construction space for $100+ million deals that's put out somewhere between $6 and $8 billion in mostly construction and heavy renovation just in the last 18 to 24 months. And they're a new player. They're backed by a significant hedge fund, but they are in fact a new player to the space. But overall, yes, I think that the capital markets are open. Liquidity is there for debt. It is simply more expensive, lower loan to value in general, lower loan to cost in general. And again, to Jonathan's point, if you have a vintage 5 to 10-year-old loan that's coming due today or has come due in the last 12 to 18, 24 months, it is significantly more challenging to refinance that loan or to sell that asset because of the relatively expensive debt in comparison to when that loan was originated. Now, again, to Jonathan's point, much easier today than a year ago with that 200 basis point sort of compression. I mean, we're hearing that the CMBS market for the right deals, mostly for SASB, single asset, single borrower, either portfolios or very large single assets, some of those rates are coming in 225 over, even as low as that. And on the SOFR market, we're also seeing a 2 handle in front of the interest rate. But again, those all-in rates are still in the 6s and 7s versus all-in rates in the 4s and the 5s. And that does impact your capital stack fairly significantly, given that in many cases, and this may be a segue to one of your next question, in many cases, cash flow is at or slightly above where it was even just 4 and 5 years ago. And on an inflation-adjusted perspective, it's much more challenging. So again, capital markets wise, very much agree with the sentiment, but we are seeing a lot of activity on the refinance and the recapitalization side and from the special servicing side, and less activity looking more in line with 23 and 24 from a transaction and mergers and acquisition perspective.
Let me add on to that just very quickly. So what Evan just said is important, right? Because there's basically plenty of available credit, right? But in doing a refinancing, right, every existing investor is looking at the CapEx needs, and there's a lot of deferred CapEx in the hospitality industry as people were not thing to do PIPs or do other CapEx projects from 2020 to 2023 or so. And now they'll do it, but only if they understand that they can also refinance their debt, right? And they're not throwing good money after bad money. And then on the new deal and acquisition side, there has been for a long time and continues to be a disconnect between buyer and seller expectations. And one of the things we typically see before the ALIS conference in January is a lot of deals launched by the brokerage firms. And we've seen probably as many as we have in any recent year. But the question is, how many of them will actually get completed when CapEx is factored in, higher overall cost of borrowing is factored in, and pressure on cash flow is factored in. So that's where we see a big disconnect. We would see a lot more lending volume if there are more acquisitions, right? But for there to be more acquisitions, you need buyers and sellers to be able to meet on price.
So liquidity, changes in policy, deferred CapEx. Walk me through a little bit about margins, profitability, kind of in that regard. What is keeping the owners up at night? What are they thinking about? What's driving their business plans now? And Evan, I'm going to give it to you just because Jonathan has now complimented you twice. So we're going to go for the hat trick.
Well, I appreciate that. I'll take 2 out of 3, by the way, so it doesn't really matter. This is a mulligan, if you will. And by the way, just joking aside, I do agree with what Jonathan said. I mean, it is tying up transaction and making things a lot more challenging. So what's keeping owners up at night? I think, listen, the expense side of the equation, I think has been a challenge since COVID. And I think it's even more of a challenge today than ever before. 3 main factors, in my view, and we've all heard this many times before, but it continues to rear their ugly heads: insurance, taxes, and labor. Depending upon the market that you're in, one of those factors is more impactful. If you're in a place like South Florida, and not to mention it, but unfortunately Los Angeles and a lot of those areas, I can't imagine what certain types of insurances are going to cost, if they're even available at all, and to what extent they're available, and where the government comes in to back things. So insurance continues to be, because of natural disasters and other significant expense, and one that in places like South Florida has settled at 2x where it was prior to COVID, if not more. And that's where it's settled. That's sort of the stabilized point of it. Taxes also have gone up and continue to go up in many municipalities, think Cook County, in Illinois, and other more leaning blue states, not to get political about it, but that just is in fact the case in many instances, not all, of course. And then on the labor side, we talked about immigration and migration before, but even without that issue, even before Trump went into office, the administration started with these new or these enforcing these older policies, there's been a massive challenge in labor. I mean, typically, to throw out sort of a very broad-based example, a housekeeper or a front desk person in a suburban market in North or South Carolina, let's say, back in 2018-19 was probably earning somewhere between $8.50 and $10 an hour. That person today is probably earning between $14.50 and $16 per hour. And I will tell you that that average rate, if you're lucky, their average rate and or the RevPAR are up and on an inflation adjusted basis, 3% a year. Well being outpaced by the increase in labor. And there's really, especially in limited and select service hotels, there's very few levers to kind of go after that loss in profitability. So I think margins have compressed. I think margins will continue to compress. I think our LARC platform is projecting 50 to 100 basis point compression in margin in 25 versus 24. And I think that continues to be a challenge. And just one last comment on this. When we talk to a lot of investors, they say, "What do you like?" And I say, I like the barbell markets or the barbell asset types, bottom and top. I like the bottom because you can control labor, 5, 6, 7, 8 FTEs, full-time equivalent employees, relatively low expense margin, and, incremental increases in RevPAR that really matter because it really pushes GOP and net operating income on the bottom line because of the ability to control many of your expenses, particularly labor. And on the high end, I like those markets because they're not always, but generally there are levers. Another food and beverage outlet, more profitability, another grab and go, spa, amenities, programming, and a better ability to raise average rate for a customer that is less price sensitive than many other customers. The middle of the pack is really where we're going to see challenges because they're mostly they're 85 to 95% average rate and occupancy rather. RevPAR is their income base, their revenue base, and then their ability to control expenses and their ability to increase rate are much more limited by the requirements of the brands and the management companies on the labor side. And then in terms of the pushing of RevPAR, they're much more limited by the competitive sets that they lie within because there's not a lot of differentiators as opposed to on the upper end.
So a few high-level thoughts to add on here. One is, if you look at all of the top sort of industry prognosticators and projectors, they think that for 2025, we end up at somewhere between 1.5% and 2% RevPAR growth, right? That's occupancy times ADR. Historically, the rule of thumb was you needed 3% annual RevPAR growth to maintain your EBITDA margin because expenses, both operating and fixed expenses, were growing at kind of that same rate. Now, as Evan pointed out, we have both operating expenses and fixed expenses like property taxes and insurance growing at well above the RevPAR growth rate. Right, so unless you're growing your food and beverage revenue extremely aggressively or parking revenue or otherwise somehow operating way more efficiently, you're going to have declining EBITDA margins. Additionally, if you look at occupancy nationally, we're not back to where we were pre-COVID. We're not back at 2019 levels, but average daily rate is well above where we are. And there's a reason for that. The reason for that is the massive inflation that we've had. So if you were to inflation adjust the RevPAR, 2024 RevPAR, 2025 RevPAR, on an inflation adjusted basis, so real RevPAR is somewhere between 6 and 7% below where it was in 2019. So, that's, when you think about, is the industry more profitable, even with people learning to operate better, you need top line growth in order to generate bottom line growth, right? Everyone's operating fairly efficiently right now, and it's tough to squeeze a lot more efficiency out. And when you look forward over the next few years, there don't appear to be significant catalysts for massive top-line growth or massive margin growth. In fact, the overall economic outlook seems to be fine, but the expected pressure on wages and taxes and insurance and on food product, on everything, is projected to significantly outpace the revenue, which is not a good place for the industry.
Okay, I got two more questions to go through. And I'm going to kind of mix this next one together because that's how people approached it. Over the last few years, a lot of the brands have been saying that they're not going to be investing in certain markets, major cities like New York and LA, Chicago, because of crime rates. They said until local government deals with the crime rates, they're not as interested in investing in those areas. Internationally, we've heard brands saying that they've had challenges investing in certain geographic areas because of disruptions to supply chains, and like in the Middle East, Eastern Europe. In terms of the approach we're now seeing in the shift in government approach towards immigration and crime, however, we have seen some recent terrorism activity, be it Las Vegas with the Cybertruck event or a lot of cybercrime we're seeing now and AI kicking in. What are your thoughts on the industry dealing with these events? Because really, on the one hand, hotels aren't trained to deal with these events, right? We're not taking staff and turning them into law enforcement, but they do have to train the staff to deal with certain level of events. So how do you think the hotels are going to deal with questions of terrorism and crime and so forth in their business plans for 2025 and beyond?
Sure. I don't think the hotel owners and operators are changing that much of what they're doing, right? There'll be certain cities and areas and certain higher profile hotels where there may be a little bit more focus on training and security, on awareness. But from a brand growth perspective, if you were to look at Hilton, who just reported their earnings, and Marriott, they make their money based on fee growth, not based on ownership of assets. They make their money on management fees, franchise fees, incentive fees, credit card fees, timeshare fees, etc. And as a result, because they're very asset light, they trade at almost double the valuation of the hotel REITs, right? The EBITDA multiple that Marriott and Hilton trade at is almost twice what the average of the hotel REITs trade at, because they don't have to spend the capital. In fact, they can turn around and tell owners, we have to spend money on these security measures, and the owners basically have to do it, whether it's in franchise format or management format. So I think nationally, that's not as much of a concern for most owners and operators. The brands will kind of go just about wherever they think a viable hotel exists if they can make the fees on it. And if it's not Marriott or Hilton, it'll be one of the significant or less significant competitors.
Yeah, I generally agree. I mean, I don't think the hotel industry is going to change too much on the security side. I mean, we've already seen it. The challenge with hotels is they're supposed to be hospitable. And part of that is being open to the world, right? Allowing people in food and beverage, allowing people in to utilize your lobby and your Wi-Fi and your restrooms so that they eventually spend money, and also that they feel like they're part of a certain city. So security is really, really challenging with hotels. I mean, yes, you can restrict access to guest rooms and you can restrict access to certain parts of the hotel, by key card or whatever it may be. But, it's really hard to restrict access to hotels in general. I mean, I think you've seen in certain markets, even union members come in. If there's a union challenge there, they can come in and protest in the lobby. Why? It's really challenging to restrict their access when, all they have to do is just walk in as a regular looking guest and then start protesting. So I think hotels do the best that they can, but it's sort of this dichotomous pole of security and being closed off versus being open. I mean, we've all been to Israel, for instance, right? And even in Israel, where there's a security guard, armed security guard at the front, and sometimes there's a metal detector, people get lax over time, right? There's just so many people coming in and out. And if you want to feel welcome at a hotel, especially if you're a guest and you're paying hundreds, if not thousands of dollars to stay there, I mean, do you want to be frisked every time? Yes, you think about security, but on the flip side, you're kind of like, this is annoying. But overall, I think it's a challenge. It's going to remain a challenge and probably become an even larger challenge over time, where certain hotels are targeted given where they're based, where their brands are, who their CEO is, and who their clientele is, and who they accept as their clientele.
When I walk around, the one thing I hate people saying when I say to them, how you doing, and so forth, and they say, same old, same old. I hate that response. But when I was at ALIS, everybody was pretty much telling me that they're optimistic. Are you optimistic?
I heard a stupid term, and I'll let Jonathan answer first. The stupid term was reserved optimism. I don't know what that means. Maybe I'm just not smart enough, which is entirely possible. But
it's something we can all agree on.
Yeah, I think so. I think there's consensus on that. We have a Bezdin here. But I believe that the word optimism was involved in most, if not all, of the folks that I was speaking to as well. And I would say generally that there is a level of optimism, mostly because 23 and 24 were pretty stable and pretty flat from a financing perspective in terms of expense, and from a transaction perspective, because, a lot of people don't have a lot of equity remaining in deals because of that capital market structure. And to what Jonathan said earlier, though, we are 200 basis points, generally speaking, from a high level inside, from a borrowing perspective, inside of where we were just a year ago. And that will spur that, and frankly, necessity will spur activity. So I think on the capital market side, the debt brokers are quite enthused. There's a lot of changing of management companies. So I think those folks are enthused. The brand folks just keep rolling out new brands and shoving them, their pips and their overall requirements down the owners and borrowers' throats. And you know what? They do it because they can, and the borrowers accept it because and the owners accept it because there is so much value in most cases to being branded. I think optimism. I'm quite optimistic about 2025. I think we, in like our world, right, as service providers, us, JF Capital, and Jonathan, and Yariv, you and Herrick, should all have, God willing, good years because of the relative activity. And most of us, it matters if transactions happen, mergers happen, acquisitions happen, et cetera. But we're fairly good as long as there's activity of some sort, either good activity, which we hope for, or even bad activity, litigation, support, expert testimony, and that type of activity as well. So I think we should have a relatively robust year. And I'm quite optimistic for the industry, just because I think also something we didn't touch on, and I'm sure we can do on a future podcast, but innovation. Technology has to come into play more so for hotels. But there will always be, especially at the higher end, a human element to it, but there has to be more technology that will ultimately reduce labor costs, reduce operating costs, and overall even reduce just overall cost of goods. So as technology can take hold of that hopefully within the next 5, but even 10 years, that'll produce optimism on the margin side, where I think there's been less optimism in other sectors of the industry.
So let me go kind of macro. I do expect there will be more transaction activity, more sales, more financing, more brand changes, more everything. And that is because the markets and all the market participants like certainty, right? 2024 was a year of uncertainty where we had a pretty significant presidential election year. We had during the year, we had the first, after massive run up in interest rates, the first declines in interest rates, and at a minimum, sort of a pause in increasing interest rates. So, the capital markets, whether they're debt providers, equity investors, others, can make decisions a lot better if they have more certainty. And while they still don't have certainty in terms of all of Trump's policies and what a Republican control of the House and Senate looks like, right, there are certain parts of the business that will react much more positively, to what they're seeing in government now versus 4 more years of the previous administration. That's not a political comment. It's just an economy and capital markets comment. So the capital markets are overall more bullish. People are willing to make certain decisions and have more optimism than they did before. I personally am excited and optimistic about it because, as I said in the open, my business is around complicated transactions and restructuring. And I think when there is some level of certainty and still some uncertainty, right, there are more restructuring transactions to do. People are able to make some level of decisions intelligently as to where value is, where they could find new financing, when it makes sense to deploy additional capital. And that's good for our business, right? But I think there will continue to be a lot of challenged assets and valuation, even if they're performing. In many cases, the assets themselves will be performing fine. They just have too much debt or debt that's maturing and can't currently be refinanced. So, we're optimistic, but because we think there are a lot of challenges.
Gentlemen, this has been really insightful. I think people are really going to take away some important items that they're going to think through as they plan 2025. Thank you as always. You've been wonderful. Thank you all for listening to Herrick Does That. Thank you very much.
Thank you very much for joining us for Herrick's podcast, Herrick Does That. To learn more about our firm and to listen to additional podcast episodes, please visit us at www.herrick.com.